Well, hey there, everyone. Happy Thursday, December 4th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautiful, classic December day here in Redmond, Washington. Hope you guys are all doing well, hanging in there wherever you're at. Nice late stage rally here, the last 20 minutes, recovering the S&P back above the zero level. What you're going to find as we go through the charts today, Dow slightly lower, S&P slightly higher, NASDAQ a little bit more, with the VIX now pushing just slightly below 16 into today's close. We are very much in a low volatility environment. Low volatility basically means that the options market implying very small percentage changes in the major averages. So a day like today with the major averages essentially choppy and not having a big directional move, sort of what we should expect to happen more often than not, with a volatility reading of VIX down in the mid-teens. You're going to find some of the sectors were up, some of the sectors were down, breadth kind of skewing neutral more than anything. Kind of a neutral day in a lot of ways. However, there were some charts breaking out, some charts breaking down, and we've hand-selected a couple of those to highlight on both sides of it. Thanks so much for tuning in, all of you. As a reminder, we welcome your questions at any time. Use the comment section here on our YouTube channel. And we hope to feature one of your questions in our next mailbag episode. I'll actually be at the Stock Charts office in downtown Redmond tomorrow. So expecting a normal publishing time for the show, but we shall see, working on some projects with the folks there tomorrow. All right, let's talk about what happened here in the market recap. As I mentioned, sort of a mixed bag, but generally speaking, light move day, right? Around 2:30 Eastern, the S&P was down a bit to 68.30, ended up rallying in the last couple hours, specifically in the last like 15, 20 minutes, got us back above yesterday's close to push up to around 68.57. It's only up about 0.1% from yesterday's close. The NASDAQ a little bit better, but still up less than 0.25%. The Dow ended up slightly lower, but essentially unchanged. Small caps were down after leading the other indexes tomorrow. Mid caps sold off a bit in the afternoon session, still up about 0.5%. That's the top performer out of the major U.S. indexes. As I mentioned, volatility, getting low and staying low. The VIX chopped around in the 16s today, but going into the close with that rally in stocks, volatility declined, and the VIX now below 16. It's been a while since the VIX has been down into those general levels, and this low volatility environment with the VIX in the teens basically tells you the options market pricing in very small day-to-day movements in the S&P 500. So a day like today where we're chopping around but no real significant move should make sense, right? If you think about what the VIX is actually telling us. As a reminder that the volatility readings are one of the great red flags I've learned to watch for. A VIX spiking above 20 would tell us that this low volatility, all is good kind of uptrend may be ending for today, though. Still in the bearish realm, down around 16. Looking at interest rates, so we can see rates kind of pushing higher by a bit, not a ton though. 10-year yield around 4.1%, long bond yield 4 3/4, 5-year point just below 3.7%. In case you missed it, our latest episode of the Market Misbehavior podcast was a lot of fun. What all did we talk about? It was with Joanne Bianco from Bond Blocks. That's right. We talked about bond ETFs. We talked a lot about fixed income markets, talked about interest rates, talked about the Fed, and thinking of getting access to the fixed income markets through an ETF structure. And that was actually a pretty interesting discussion to have. And I enjoyed being able to ask some questions about fixed income, some of the risks involved, that if you're more of an equity person, you may not understand the fixed income markets, as well as others, but hopefully my questions with Joanne helped to fill in some of the blanks for you. So you can check that out on our YouTube channel. Just went out this morning. The bond markets in terms of prices were down today. So the TLT down about 0.5%. That's a Treasury ETF. The dollar slightly higher and trended higher through the course of the day. Looking at the commodity space, gold basically flat for the day. Silver is where the action was, with the SLV down about 2.5%. Gold ended up just pretty much just being a choppy sideways day with no real movement. So stocks in gold kind of in that sideways realm, but silver very much an outlier. It was a big gap down out of the open and ended up sort of treading water through the remainder of the session. Crude oil prices, natural gas prices all moving higher. The energy sector Looking more and more interesting at times. We're going to show you a chart of oil services, the OIH, pretty constructive chart, and some of those names of those oil service and that oil service group, pretty compelling. These are stocks making new 3-month highs. These are stocks starting to improve. These are not AI plays. These are traditional energy plays, oil plays, and starting to imply some optimism about crude oil prices. Cryptocurrencies, again, there's no real VIX for cryptos, although I'm sure that's probably only a matter of time before there's some widely accepted measure of volatility. But for now, we just have to pay attention to the price action. And if there was a VIX on Bitcoin, it would probably be, I don't know, 30, 40, something like that. I mean, just the day-to-day fluctuations are aggressive. Today, Bitcoin trending downwards, just above 92,300. That's down just over 1%. Ether price is down on about 1.7%. All the top 10 coins in the red. Now, Bitcoin did get up to around 94,000 over the last 48 hours, but over the last 12 to 18 hours, generally trending lower, while equities sort of holding steady. Bitcoin and Ethereum rotating to the downside. Not a great sign, I would say, because Bitcoin and Ethereum, pretty good measures of speculation. And if those continue to sell off, we get back below 90,000 on Bitcoin, for example, I think that would be a bad sign for stocks, most likely. Looking at the 11 S&P sectors, pretty mixed, to be honest with you. Communication services was the best, only up about 0.6%. So no real big breakout sectors today. Industrials and energy round out the top three. So industrials up about 0.5%, XLE up 0.4%, technology close behind energy there. On the downside of the half of the sectors that were down, healthcare the worst, down 0.8%, materials down 0.6%, consumer staples down about 0.5%. So healthcare, that's an interesting one because the healthcare sector has been arguably one of the more compelling sectors in terms of improving technical characteristics. We've seen the XLV start to improve in areas of the healthcare space at times, like pharmaceuticals, like medical supplies, at times looking quite strong here. Pulling back today, and the least good sector today. Breadth conditions were actually pretty mixed. It depends on where you look, but at the New York Composite Index, which is the most important one in my book because it's a broad universe that covers a lot of sectors and a lot of styles, growth, value, big, small, it's all kind of in there. So it's a good sort of broad universe to think about when you're talking about breadth indicators. 47% up, 50% down. The NASDAQ composite, I always hesitate to quote too much about NASDAQ breadth because there's sort of a natural negative tendency to NASDAQ breadth readings because some of the lower quality names in the NASDAQ tend to just be struggling, but 58% of the NASDAQ composite members were up. The S&P almost an exact coin flip between up and down, but look at the small cap index with the worst breadth of all of them, almost a 2-to-1 ratio of stocks down versus up today. Intel, when we look at individual names, we'll look at the market carpet in a minute, but Intel stands out as the worst performer in the S&P. That chart flashing a very important 3-candle bearish pattern. We'll show you that candle pattern here in a little bit when we get to the charts, but keep Intel in mind. That could be a bearish sign here for the rest of this week, really into the beginning of next week. On the Magnificent Seven and Friends, kind of leading growth stocks, you have Meta up 3.4%, NVIDIA up 2.1%, Tesla up 1.7%. Those are your 3 top performers. And if there's one real issue with this market through the course of November and now into early December is the fact that NVIDIA has still really not participated in the upside to the degree that you would hope. If the AI trade is going to get us out of this little November corrective kind of mess, and if we're going to see a lot more upside, I would expect NVIDIA would need to be a part of that in some small or large way. Up a bit today, up 2%. That's encouraging, but really still trying to break out of the range that we experienced over the Thanksgiving holiday week. Amazon down 1.4%. That's pulling back after we'd probably call a shooting star candle on Tuesday's session. Apple with 2 down days, down about 1.2% today. And Netflix, which I would argue clearly the worst of these charts from a technical perspective, rounding out the bottom 3. That's in a clear pattern of lower lows and lower highs. All right, let's look at the heat map. As a reminder, we are welcoming your questions at any point. We're planning an all mailbag episode on Friday. We'd love to answer your questions when we take some of the best questions from our viewers. So please just use the comments section on our YouTube channel and drop a question there. We'd love to hear from you. And maybe we'll include your question in tomorrow's episode. All right, looking at the heat map, this is very much a neutral day, right? You see a little bit of green, a little bit of red, but it averages out to pretty much a neutral color. And to be honest with you, most, if not all of the 11 S&P sectors kind of in that configuration, right? There's some things working, some things not working, and the average is probably neutral. And that's why the S&P and the NASDAQ were basically flat today. That's kind of what the stocks did. So let's focus on some particular themes. So in the technology sector, while NVIDIA was up, that's good. While Oracle was up, that's good because it's been struggling quite a bit. The rest of the semiconductor space, not particularly strong today. I'm noting particularly Intel pulling back after making a new high yesterday. Micron potentially making a lower high, and that's arguably one of the more concerning charts, I would tell you, in the semiconductor space, because again, if AI fueled optimism is going to make us rally in December into the beginning of next year, if you feel like that pullback in November was a joke and that's just another buyable dip, I would hope, I mean, I think you should hope that that technology, particularly semiconductors, start to improve, because if the AI story is leading, these AI names should be looking better than they are right now. Semiconductors generally a very mixed day, but some of them down pretty good. Intel down over 7% today. Meta having a nice bounced off of $600 a share, again moving higher today. That's an interesting one because I would say Meta and Netflix, clearly the two worst charts out of the Magnificent Seven kind of group, Magnificent Seven and Friends, kind of those mega cap growth stocks. If Meta can improve from here, that'd be a dramatic reversal and would be pretty encouraging as well. You're also seeing some breakout names in consumer discretionary, particularly some of the travel names, something like Marriott pulling back today. Home builders like Lennar, DHI, all pulling back a bit. Hilton, kind of similar to Marriott. Hilton's a pretty good chart, right? I mean, if you look at what the chart was telling you, through last week, pretty encouraging, right? You can see resistance around 275 to 280 were the peaks in July and September, and then again in October, again mid-November, we finally break out. And it seems like a really good breakout above 280. That breakout day was pretty much it. We never really made it much beyond that. And now today we're closing back below the 21-day EMA. So this feels almost like a failed breakout pattern where you've got a resistance, you break out, and instead of buyers coming in and optimistically accumulating more, you're seeing investors sell the breakout. And sell the breakout is the kind of phrase you throw around during a bear market, right? That's when stocks that do have something good going on, people are just so excited to cash out and take some profits on a winner that the trend really can't participate on the upside, really can't continue on the upside. MasterCard's kind of a struggling chart here, and I would say from a technical perspective, undeniably a downtrend phase, right? What we call a distribution phase. I think of a chart at any point is in one of two phases, or one of three phases, that is. An accumulation phase of higher highs and higher lows, we're above moving averages. A distribution phase of lower lows and lower highs, we're below moving averages. Or a consolidation phase where we're basically sideways, even highs and lows. This certainly feels like a distribution phase to me, right? We've failed to hold key moving averages. Most recently, broke below the 50-day and retested it and failed a couple times. Bounced off of the 200-day, broke below it, failed from below. Just today, once again, failing from below. This would be the dreaded bearish engulfing pattern, or a bearish outside day, a big up day, a big down day, day two, wider range, open higher, close lower. That's a short-term reversal signal right at the 200-day moving average. If I'm a swing trader, which I'm not primarily, that's the kind of setup that I would look at for shorting within a pattern, right? Because you have this clear downtrend pattern of lower highs and lower lows. You have a two-bar candle pattern happening right at the 200-day moving average. That certainly feels heavy. And the momentum remaining pretty strong all through October, November, now into December. RSI below 50 almost that entire time. So MasterCard, a struggling chart for sure. What else on the market carpet? I think that's about it. I mean, note that, healthcare, which has been one of the better places, not much follow through today. This is really a day when things which had been starting to work kind of stalling out a bit. I mentioned some of those consumer names and others that have been breaking out, and now some question marks here. I mean, an uptrend is driven by stocks breaking out, and if stocks break out and fail, if stocks attempt to get above resistance and fail to do it, like MasterCard, that's a concern. And I would say that is what I'm. If we see more of that, I would say that's an argument against a fabulously bullish December. Keep tuned. We'll keep watching these charts through the course of this month and certainly into the new year, and keep you updated. We'll look at some charts here in a moment. Just to let you know, last call, our friends at Seeking Alpha doing their Black Friday sale this week. Pretty decent sale, 20% off all of their products. The three things that I've looked at and have used in different ways. Alpha Picks is where they use their quant model and hand select some key stocks to dig a little deeper. I think it's a great balance of systematic tools like a quantitative model and scanning tools, but also the benefits of diving deeper into particular names to surface compelling ideas. You can find more info about that at marketmissbehavior.com/alpha picks. You can also check out their premium memberships, also on a Black Friday sale. Go to marketmissbehavior.com/seeking alpha. And finally, you want to bundle the two and get their premium tools like their quant methodologies and scanning capabilities and all the member-only researching capabilities, as well as their premium alpha picks. You can bundle them together by going to marketmissbehavior.com/SA bundle for Seeking Alpha bundle. Thanks again to the folks at Seeking Alpha for being longtime partners of Market Misbehavior. All right, we'll wrap things up and then call it a show. I'm actually scheduled to speak to the investment club at Bowdoin College in Maine. I used to go recruit at Bowdoin when in my Fidelity days. So excited to talk to the student investing club there and give them some an introduction to technical analysis. We might highlight some of the charts we're sharing with you here. So I have to wrap up quickly so I can go and get on a call with them and give them some thoughts about using charts in their process. But let's look at some charts together, you and I, and see what we can find. We added this what we call a traffic light approach to the S&P. I don't do that all the time. It just depends on the setup. But anytime you have a big move and then you kind of retrace a little bit, two things come to mind. Number one, Fibonacci retracements, because that methodology is really designed to help you anticipate and identify some potential support levels within a range. So when you've had a big run higher and then you pull back, Fibonacci retracements make a ton of sense, which is why we're featuring them on the chart of the S&P right now. But also what I call a traffic light technique, because once you're sort of in a range, there's usually a clear level at which you would say, all right, that's no longer a range. We're back to being in an uptrend. Whatever was happening before the consolidation is resuming. And for me, that's a break above 6,900. On the other side, a breakdown below support would tell you, okay, this is no longer an uptrend. This now looks like a new distribution phase because we're making lower highs and lower lows. So for me, an S&P below 6550, that's a red light, probably a dangerous market. In the middle, it's neutral, it's yellow. So I would say at this point, it's sort of wait and see mode. I mean, again, if you look in the last week, or at least since the rally during the Thanksgiving holiday, from there, we've really been just kind of treading water this week. Again, there's not a ton of earnings to digest, although there's some. We'll highlight a name or two that reported so far here this week. Not as much macro data because of the shutdown and that engine of reporting on labor data and inflation and unemployment, all that still kind of getting back started. We'll see what happens as we gather more data on jobs and prices, et cetera. But for now, I would say the market kind of holding its breath and waiting to see what sort of catalysts we have. Also, the last Fed meeting of 2025 looming large next week. Market pricing in basically 100% chance almost of a 25 basis point cut, the last one of the year at the last meeting. Market pricing in not much happening at the beginning of next year, but I think that's what we as investors will be looking at is what the language is in the official statement, but certainly in the press conference afterwards, what kind of color we can get. Note that this rally here in the last week or two, RSI has not gotten above 60 yet. If there's an asterisk to this rally where you want to say, I'm not sure if I'm convinced yet, RSI still remaining in a bearish range is enough for me to be a bit skeptical, but we'll see. We'll see what happens. Breadth data, I mean, a bit higher today, but overall not great. I mean, you can see 56% of the S&P 500 members are currently above their 50-day moving average. That's good. As long as that holds 50% in the days and weeks to come, that means the short-term breadth is good. The percent of stocks above their 200-day, just above 60%, that's good too. As long as that holds the 50% level, as it did on the pullback in mid-November, that's telling you the long-term breadth is still bullish. Both of those, I would say, constructive here until proven otherwise. Big shift in the sentiment data to share with you. This is the AAII survey, the American Association of Individual Investors. This is a weekly survey of members of the AAII asking what they think about the equity markets. Are you bullish, bearish, or neutral for the next 6 months? A group of people and a subset of that membership has been voting every week for years and years and years. And that's one of the great benefits. It's not a perfect survey, but it's been around for so long. We can really look at what's happened around the survey during other cycles, which is what I think is so helpful. We're right at 44% bulls. Anything above 50% for me feels pretty frothy and a little overheated. We're not quite there yet, but we're getting there. We now have the lowest percentage of bulls going back to January of this year. So 31% bearishness reading is what I meant to say there. If I said bull, I meant bear. 31% bears responding this week is one of the lowest readings we've had, which means the spread between bullish versus bearish now favoring the bulls. Last week, we were about 10% bears over bulls. This week, flipping, about a 10% drop in the percent of bears, about a 10% gain in the percent of bulls. So this survey has flipped from net bearish to net bullish. Now, it's been net bullish a couple times previously, here in late September, here in mid-October. If you look at the chart, you will find that both of those previous times, market pulled back actually very quickly. The time before that, if you go past the summer months, back here in January, just before the peak in February. So we're getting arguably a little too much optimism. If this ends up being a much larger uptrend, then it's kind of okay, right? If the sentiment gets bullish and kind of stays there. So we're right at kind of that critical point where if this is going to be a sustained bullish rally, the sentiment should get better and better from here, confirming a breakout. I think this could be an important chart to watch next week. Big pivot though. The name exposure index also flipping to almost overheated levels. The last time this reading was above 100%, which for me is a big contrarian red flag, because that tells you the money managers in this survey of active investment managers are just a little too bullish right now. Back in October, we got above 100%. That was the first time in 2025 we'd gotten there. Market pulled back, of course, into the November swing low. We're almost there. So if we would drift higher and get above 100% into next week, I would argue that's kind of a negative sign and suggesting a frothy, over-optimistic scenario. Finishing off here, let's look at some charts together. All right, quiz time. Do you know what pattern this is? This is a 3-candle pattern, right? Some candle patterns are just one candle, like the hammer candle. Some are 2 candles, one day and then the second day, like a bearish engulfing pattern or a dark cloud cover. This is one of those candle patterns that has 3 days. It's a big up day. Day 2, the open and close are very close to each other and above the range of day 1. Day 3, big down day. So it's sort of like a 2-bar reversal pattern, but with this third guy kind of toward the upper end of the range, sitting at the top there. Do you know what candle pattern that is? It's called an evening star pattern, right? Big up day. You've got this, which is kind of the star, and then the big down day. If you got rid of that middle day and just kind of cover it up on your monitor, you'd have a 2-day pattern of a big up day and a big down day. And if day 2 is a narrower range, that's called a bearish harami pattern, which is an up day and a down day. But day 2's range is taken up by day 1's range. So smaller range on day 2, it's called the bearish harami. If it would be a bigger range, if you had an open up here and it closed down there, it'd be called a bearish engulfing pattern. This one with a little kind of indecision day in the middle toward the upper end of the range of the first and third days, that's called an evening star candle. The reason why I just went through that is to show you that with candle patterns, they're not all sort of independent. There are a lot of similarities. And once you understand the methodology and understand what these names of these patterns are actually reflecting in terms of the change in sentiment, it makes a lot more sense. At least it did for me when I thought of it more behaviorally and not as a bunch of random names that are translated from Japanese into English for us. So that's an evening star pattern on the chart of Intel. That's what's happened on Tuesday, Wednesday, Thursday. What that implies is the next 1 to 3 bars are lower rather than higher, most likely. If we would get a valid break above day 2's high, that's around $44, that would negate the bearish pattern and suggest a new bullish breakout for Intel. For now, it's suggesting weakness here. Kroger, ticker KR, reporting earnings today. Not good. Down 4.6%. Now, during the day, it was down to just below $61 a share by the close. It got back up above 63, and I think that could be pretty important because if you look to the left on the chart, you'll see the November lows are in play. The November lows around 62 to 63. As you can see, we gapped lower and we'd gotten up to the 200-day moving average going into today's earnings. We gapped lower. We traded much below November's low, but look how buyers came in and pushed the close back up above that level. That implies that there are buyers buying into that support and expecting a bounce, expecting a mean reversion. Let's keep an eye on the momentum and see if at least stay in the neutral range. That would be encouraging for a bit of a swing trade type of short-term thing, but for now holding support after an earnings miss. WYNN is a name we highlighted, at the beginning of the week. I actually did the top 10 charts to watch for December, and I'm pretty sure WYNN was one of them. I've got that list somewhere here. It wasn't, but I think it was on my list. I was going to say I thought I included, but I didn't. I forget what I swapped it out for. What happens is I usually do an initial list. I end up with like 15 to 20 names, and then I have to pare them down. I think WYNN was on the list, and then I got rid of it. We highlighted WYNN because it's in a consolidation phase, right? Uptrend from April to October, but now a consolidation phase, pretty consistent highs and lows. A break above 133, which would clear the September and November highs, pretty bullish. But if you look, that day that we actually broke above there, we never got higher. And now today we're actually rotating lower. So all that does, I would say, is confirm once again, we're in a range, confirm once again, this is the breakout level. And until and unless we can get a valid follow through above that resistance, it's still a wait and see kind of chart. Invesco, IVZ. So if names like WYNN and Intel are struggling, what's working? I've got your back. Here's two charts in some other sectors that are actually breaking out today. Invesco is one of those financial stocks making a new all-time high today, up over 3%, finally clearing that consolidation in October, November, similar to the chart of WYNN, right? Had a good run off of the April lows, then a sideways resistance level. I think it pays to be patient to wait for that breakout, and that's what we've gotten this week and arguably today, following through to the upside. Strong momentum, definitely in the bullish range. Final chart of the day, oil services, ticker OIH. Clear accumulation pattern, higher highs and higher lows. We're above moving averages. All the moving averages are now once again sloping higher. They're in the proper order. Price over the 21-day EMA, over the 50-day simple moving average, over the 200-day simple moving average. The momentum is strong. Pullbacks have seen the RSI not get much below 40. Rallies have seen the RSI get to the overbought range condition. The range of the RSI is in the bullish phase. And because of all of those things that I just mentioned, the relative strength is strong. I often think of oil companies as a play on crude oil prices. And while the chart of crude oil is turning higher this week, it's still not a great chart, right? Over the medium term and the long term, it's still a challenging chart. However, there are a bunch of oil companies starting to break out, implying, in my opinion, a big vote of confidence on the potential upside for crude oil and energy names. Folks, that'll do it for today, for Thursday, December 4th. Thanks so much, as always, for tuning in for Chart This with Dave Keller. Thank you so much for supporting me and Market Misbehavior. It has been an awesome year so far. We're going to have a fun in December tracking all of these charts and many, many more. If you're concerned about this market, if you're super optimistic, if you're super desperate, I hope that this regular daily process of going through the charts and sharing some tips and tricks with you using charting and behavioral tools, I hope that that helps you navigate these markets and just make sense of things a little more, if nothing else, improves your market awareness. For Market Misbehavior, I'm Dave Keller. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.